Higher interest rates may be bad for financing a home, but there is a silver lining. The most challenging part of investing and retirement planning has been balancing asset growth with asset protection. So to protect assets, we need to lower market risk, and to achieve growth, we typically need to increase risk. Now, with high interest rates, there are solutions positioned in ways that we haven't seen before. We can actually do both. Joining me is Curt Lyman with Alpha Beta Gamma Risk Management in Palm Beach Gardens, Florida. So, Curt, how do these strategies work right now?
First of all, Scott, let me say how good it is to be back with you. I think that right now we are experiencing one of the most incredible times and opportunistic times in principal protected financial solutions, including the use of multi-year guaranteed annuity contracts as well as fixed indexed annuities. Both of these strategies are particularly attractive now that we've seen this rapid rise in interest rates.
Now, how long do you think these opportunities will be around?
Well, Scott, there's a lot of speculation around what the Federal Reserve is going to do relative to interest rates, and in our opinion, these opportunities may last a little bit longer than many people expect, because I think that the Federal Reserve is finding it difficult to fight inflation. It's going to continue until the United States government begins to get its budget under control, but that creates a tremendous opportunity for our viewers. The interest rate cycle, in our opinion, is probably going to begin to roll over toward the end of 2024.
So these products are still beneficial when interest rates are lower, right?
They are, Scott. We thought that these were good strategies when interest rates were around 1%. At 5%, 4.5%, 5%, they give the insurance company the ability to enrich these policies, these annuities, in ways that, frankly, in my career, we haven't had the opportunity to see before. I think it makes for a tremendous opportunity today. The longer that you wait, that window will probably narrow a little bit more. As we get closer to a decline in interest rates, the products won't be as rich as they are today, but they'll still be very, very effective products for the accumulation of wealth, the deferral of taxes, for some estate planning benefits, and as well for the generation of income that you cannot outlive.
So is this a good time to consider refinancing an existing annuity?
Scott, I think it goes without saying that your annuity policies should be reviewed on a minimum at least every 3 years, because there are new products that come along, there are enhancements to these products, and there oftentimes is an opportunity to move from an existing product to a product which is materially better. It's similar to your estate plan. If you don't have a will, you should have one. If you do have one, you should review it every 2 or 3 years. Same thing is true with your insurance and your annuity policies.
Curt, finally, for somebody who's considering the purchase of one of these products, a fixed indexed annuity, what questions should they be asking?
I think the first is, when will you need the money? In our experience, if you can allow that indexed annuity to go full term, typically 7 years, 9 years, 10 years, maybe as far out as 12 years, you can get tremendous growth as a result of the compounding and the indexing within that policy before you need to take the money out for purposes of retirement. The utilization of the fixed indexed annuity can be adjusted based upon the individual's time horizon. Obviously, the longer the term, the more enhanced the benefits are, because the money has the opportunity to grow that much more.
That's Curt Lyman in Palm Beach Gardens, Florida. Thanks for watching Retirement News Online.